Okay, so is this rally for real or is this a trap? Hi, I'm Matthew Carr, Chief Trend Strategist at the Oxford Club. Thank you for watching this episode of Market Trends. Now, if you're new here, be sure to hit that subscribe button and turn on notifications so you never miss out on my best trading ideas, which I share here each and every week. So let's get down to it. Is this bounce for real, or is this just a bear trap waiting to maul investors? Now, it feels like a lifetime ago, but it was only earlier this month that the Nasdaq was in bear market territory, down more than 20%. The S&P 500 was in correction territory as the Dow Jones Industrial Average was hovering right near that level too. Now, the last time the S&P was in a correction was all the way back in 2020. And historically, the markets average a 10% correction every 2.8 years, right? They're way more common than most investors think. And during these, stocks will suffer an average decline about 13.7% over a 4-month stretch. So the correction we saw this year was fairly on time and consistent with what we typically see. And using history as our guide, it takes roughly 4 months for the markets to regain all the ground it lost after a correction. That means if the lows we saw in mid-March were truly the lows, we could expect a full recovery by July. That's not what's happened. Stocks have rallied hard since March 14th. The Nasdaq and S&P are up double digits in the last 2 weeks, and the Dow is racing higher as well. The markets are trading at their highest levels since mid-January. The move in and of itself is kind of setting off alarm bells. Like many would argue, with the highest rate of inflation in 4 decades, commodities that are completely out of control, the war in Ukraine, the Fed raising rates, treasuries warning of a recession. Oh, and let's not forget, we have an ongoing global pandemic as well as a supply chain crunch. With all of those headwinds, this euphoric double-digit rally, it kind of appears misplaced. Now, it's important to remember we can see rallies like this during bear markets. In fact, as Bank of America noted this week, there have been 4 10-day stretches where the markets have gained more than 10%, just like we've recently seen, in 11 bear markets. So this move really isn't out of the norm. But the thing that is kind of adding to the sort of concerns right now is the current rally has surpassed the largest 10-day returns in 7 of the last 11 bear markets since 1927. The only ones that have been bigger were in 1931, 1987, during the dot-com collapse in 2002, and the financial crisis in 2008. So in my last video, I did talk about the bounce back we see in moments of emotional extremes. Personally, I wouldn't be racing out to buy at these levels. In fact, I am taking some profits on some positions this week because we are at these highs. Now, if we find out the March 14th lows was the bottom, hey, that's great. If not, it's important to remember that not all bear markets are the same breed.
Question: what kind of bear is best?
There are structural bear markets, cyclical bear markets, and event-driven bear markets. And each have different average declines, durations, and times to recover. A structural bear market is triggered by financial bubbles or structural imbalances. Think the dot-com crash of 2000 and the financial crisis of 2008. Cyclical bear markets are a function of rising rates, impending recessions, and profit declines. And event-driven bear markets are triggered by some sort of exogenous shock, like the 1973 oil crisis, the COVID-19 pandemic, or a war kind of like, Russia invading Ukraine. The bright side is, those sort of event-driven bear markets typically don't lead to domestic recessions, but there is a lot of pressure on consumers right now because of the war and the inflation that we see. Now, from a corporate standpoint, it's important to kind of keep in mind prior to Russia's siege on Ukraine, the markets were rallying on fourth quarter earnings. Now, structural bear markets are the worst. These last for an average of 42 months and see a market decline of 57%. It then takes 111 months for the markets to recover all of that ground lost. Cyclical bear markets are part of the business cycle. Stocks will fall an average of 31% over 27 months and then take 50 months to recover. Event-driven bear markets are furious and short-lived, but they can often be the scariest. The average decline during these is 29% over 9 months, but it takes a mere 15 months for the markets to completely recover, right? It's the easiest bear market, as I've said here in the past, to tame, with a considerably shorter uphill climb than structural or cyclical downturns.
Bears beats Battlestar Galactica.
Well, I'm Matthew Carr, Chief Trend Strategist at the Oxford Club. Thank you for watching this episode of Market Trends. For more information like this, be sure to go down to the description and sign up for my free e-letter. Until next time, here's to high returns.